So hello all the CA final students. So now this is a concise video on the general anti-avoidance rules as made applicable for CA final direct taxes. And in this regard, I just wanted everyone to listen to the complete lecture such that if you can take 2 hours, 2.5 hours to understand the concept of Gaar, in just 40-45 minutes, you can complete along with all the study material questions. So once you listen and complete this, there is no need to study this concept one more time. So that's the assurance that I can give. So you can rely on the content and you can move on. Each and every minute detail inside this Gaar provisions are taken from the ICAl study material. Now it has become a trend in the ICAl that every attempt there is a 5 or 6 marks question coming from general anti-avoidance rules. So I wanted to help you in regard to the Gaar provisions in this way. Okay, let's begin. And before we start, for depreciation, okay, there are some amendments also in depreciation. Small amendments came, and understanding actual cost in relation to depreciation. Just today, I made one video for CA inter students, but I did not make with an intention for inter students. It was made for both inter and final. In-depth coverage I made just in 1 hour. I completed everything, not just depreciation calculation, depreciation, additional depreciation, actual cost, 13 explanations. Each and every minute detail just in 1 hour I completed. You can listen to that lecture and get a best results out of it. Okay, let's begin with our Gaar provisions. So see here once. General anti-avoidance rules related concept. This was introduced as chapter number 10A of Income Tax Act, and 99.99% it comes for 6 marks or else 5 marks. But 100% question will be there on Gaar provisions. First one, from the study material point of view, I'm going each and every minute detail I will cover. Please listen carefully. Okay. Point number 1. There are 3 types of things in tax: tax evasion, avoidance, and planning. Okay. See, what is tax evasion? Tax evasion is an attempt to avoid payment of taxes by resorting to illegal and fraudulent means. Examination, they are asking theoretical questions also. What do you mean by tax evasion? Like that, short notes are coming. So therefore, please pay attention. So what is a tax evasion? Tax evasion, person attempts to avoid payment of taxes by resorting to illegal and fraudulent means. Illegal and fraudulent means. If the same he tries to avoid not by fraudulent means but by logical means given by the government, then we call by general anti-avoidance. If that avoidance is made through illegal, fraudulent, it becomes evasion, or else it becomes only avoidance. Example, misrepresentation and suppression of facts, failure to record investment in the books of accounts, failure to record any receipt in the books of accounts having a bearing on total income, recording of false entries, okay, not reporting international transaction or a specific domestic transaction. All these will come within the category of tax evasion. Next one, illustration. See, again I am telling you, if you have any doubt on what I said, you know about me very clearly, you have taken AFM. Okay, every minute detail in the study material I studied, I understood, I absorbed, I felt, I experienced the concept within, and then only I am coming to deliver you the concept. CA final direct taxes. So first point, same illustration what I am taking now is already there in the study material. I don't know whether you read or not. How about, let us see. Let us take an illustration. There is a AC costing rupees 1 lakh fitted at the residence of a director as per the terms of appointment. Okay, AC fitted at the residence of the director. Okay, now when AC is fitted in the residence of a director, it will become furniture. It will become furniture and fittings. So the summary is that AC fitted in the residence of a director shall be treated as a furniture and fittings, not as a plant and machinery. So if when it can be treated as a plant, if it is fitted in the factory, then you can claim it as a plant and claim 15% depreciation. Okay, you fitted it in the residence of a director, rather than claiming it as a furniture and claim 10% depreciation, you are projecting as it was fitted in the factory and claiming 15% depreciation. An element of illegality is involved just to evade the payment of tax and to claim extra benefits. You are doing this. This is a classic example of tax evasion. AC provided to the director as a rent-free accommodation. Okay, next one, tax planning. arrangement of one's financial affairs in such a way that without violating the law, full advantage is taken of all. Means by complying with the provisions of law, without deviating the provisions of law, taking the full advantage. I will give a super duper example for you. Okay. I have written one example here. Okay. Beyond that also I will explain. Listen. What is the classic example to understand this is, see, there are 3 house properties for me. Okay. 3 house properties for me. All the 3 are vacant properties or self-occupied. All 3 are either self-occupied or vacant properties. Now what will happen if it is a vacant property without use? Even then annual value will be calculated and taxability will be attracted for house property. Next, if you are going by self-occupancy, then also tax treatment is same. But the problem is you can avail the benefit of self-occupied properties only for 2 properties, not for 3. So which 2? It is dependent on the municipal value, fair rent and the standard rent in that particular locality. Which gives you higher standard rent and higher municipal value, that property you should claim as a self-occupied property such that deemed let out will have a lesser taxability. This is tax planning. Means lawmaker himself has given us a chance. Do this and get it. Next, 80 let deductions are there. All the deductions are what? It is a benefit that was given to each and every taxpayer. Take the benefit, plan your taxes accordingly. Next, if you are going by cess establishment, there are exemptions. 10AA exemption is also there. Correct? So those are all the things. You can take the full benefit of all those things provided you follow the law properly. So from this, what you have to understand, tax planning is permitted under the act to keep the tax bill minimum. Examples. Okay. Next, tax avoidance is the important theoretical question. Tax evasion we understood, tax avoidance we understood. Now comes the tax evasion we understood, tax planning we understood. Amidst of both of these, there is a different world in itself. Okay, that's called as a tax avoidance. So between the 2 extremes of tax planning and tax evasion, there exists a vast domain for selecting a variety of methods which, though technically satisfying the requirements of law, in fact circumvent it with a view to eliminate or reduce the tax burden. So it looks like tax planning, but actually it's a tax avoidance. Example, treaty shopping, DTAR, dividend stripping, dividends chapter, bonus stripping, capital gains, bond washing transactions. Classic example is a treaty shopping. Classic example is what here? Treaty shopping. What is this treaty shopping? You might have read that in the DTAR. Now I am not going to discuss about that. But dividend stripping and bonus stripping I will be covering here because those are having direct link with the tax avoidance. And moreover, last 2 attempts back, a 6 marks question came from bonus stripping and a 6 marks question also came from Gaar. So if you listen to this, a 12 marks area. Okay. By God's grace, if it comes na, tambola. Let us understand now. So between tax evasion and tax planning, there exists a vast domain where people can take a good advantage. That's called as a tax avoidance. Okay. First, let us see counter actions. Sir, I am doing tax evasion. What counter action government is taking? IT authorities are already vested with the powers to conduct inquiry and investigation. For tax planning, permitted by government already, so no counter needed. Tax avoidance, strong counter actions are required because they look like good, but they're actually bad. They look like good, but they're actually bad. Okay, next. Very, very important. Concentrate from here. Tax avoidance, there are 2 types. SAR, GAR. Sir, what is the SAR, GAR, sir? Okay, SAR, specified anti-avoidance rules. GAR, general anti-avoidance rules. What is the difference between specified and general? That's the next question. So what countermeasures are taken? SAR means specific anti-avoidance rules. Okay, GAR means general anti-avoidance rules, as I said. When I say general, it is anything other than special. Okay, anything other than special. Actually, that list is very big. Which one? GAR provisions. Specific anti-avoidance rules means already within the Income Tax Act, there are certain provisions that were introduced in such a way to avoid this tax avoidance concept. To avoid tax avoidance. Okay, I will give one classic example for you to understand. Related party transaction, section 40A. Okay, 40A, PGBP. Okay, you will buy the raw material from the related party, like your relative or any close associate, business partners, partner in a firm, etc. And you will tell that, okay, you are purchasing it at 1000 rupees, but the actual market price is only 800. Means just because it is your relative, you are showing it at a higher price, or you may sell it at a lower price. Like that you can do. For that already provision came na. What is that? When you transact with a related party under section 40A, then the assessing officer has a right to ask you, question you about the validity of this transaction. If it is not on arm's length basis under PGBP, then the balance will be treated as your income. Means tax avoidance to some extent is encountered and counted there itself under section 40A. That's what. Expenses not deductible in certain cases. 80 IA 80 is there. Okay. Next one, chapter 10, transfer pricing. Transfer pricing concept is what? Arm's length price. Which one? Arm's length price. Associated enterprise transaction will happen and you will quote at extreme prices or very low prices. So for that, separate section 90 to 92 itself completely, including the safe harbor rules. Everything is applicable for transfer pricing provisions. It's a tax avoidance scheme. Bonus and dividend stripping, extremely important for exam. Either in a 14 marks question they will ask as an adjustment, or they can give a separate question like in one of the 2 attempts before exam, 6 marks question came. Dividend stripping is not relevant now because dividend became taxable. Previously dividend was exempt na? At the time people used to do this, but now that is reduced, but bonus stripping is important. Next one, deemed dividend. Loan will be taken, actually that's not a loan, that's a dividend only, taken in the name of loan. Therefore government is again controlling you in doing the tax avoidance. Next, 43.1, notional cost. Which one? Notional cost. Section number 43, just now I said at the beginning of the lecture. Depreciation read with section number 43. In that actual cost, what will be there? In that actual cost concept, whenever you purchase, there are 13 explanations in actual cost. How many? 13 explanations are there. One of the explanation I will take as an example for you to understand. Okay. So whenever you are purchasing an asset, second-hand machinery, okay, second-hand machinery you are purchasing. That means one person already used and gave it to you. Now you purchased. At what price you have to record it? Actual cost. Actual cost should be recorded at what price? You should take the actual cost of acquisition. You should take the actual cost of acquisition. Means what? What price you purchased from him, second-hand machinery, that price. However, sometimes in order to claim more depreciation on second-hand asset, you will do the invoicing. You will do the invoicing at a higher price such that you can claim depreciation at an inflated amount. Then assessing officer, if he get a doubt on you, he will send a notice and demand you to give a reason why you purchased at a higher cost. If there is no proper reason from your side, he will not consider your price. He will consider the fair market value of that asset as the value of that particular asset. Everyone understood? This is what said in 43. Go to depreciation lecture and listen. Okay. Final level, I have taught each and every minute details of depreciation topic. Next. Like this, many more. You ask me, I can tell 39 sections are there in Entire Income Tax Act, which specifically concentrates on tax avoidance. Next one. Other cases. SAR is not comprehensive and not sufficient. Wherever required, they kept. But government felt there is a need for Gaar. That's why they introduced this particular chapter number 10A. Okay. With that rule 10U, rule 10UC. Okay. Rule 10UC is introduced. Okay. Hey, this is not RIOU. Rule 10U, rule 10UC inserted. Summary applicability of Gaar. Is there a tax avoidance? Okay. Yes, sir. Tax avoidance. Gaar does not apply. Tax evasion. Gaar does not apply. Investigation will apply. Tax planning. Gaar not required. Allowed. SAR. Gaar not applicable because anyway already there. Na? Tax avoidance not dealt by SAR. Then only Gaar will apply. Very good. From here, exam question. Last attempt this question only came. Non-applicability of Gaar. Okay, when Gaar does not apply, the aggregate tax benefit in any relevant assessment year arising to all the parties to an arrangement is less than or equal to 3 crore. Less than or equal to 3 crore. Means the tax benefit you are getting, if it is less than or equal to 3 crore, then Gaar provisions does not apply. Means intention of the government is Gaar has to come into place only when the volume of tax benefit, not tax amount, tax benefit you are getting should be 3 crore or more than 3, should be less than or equal to 3 crore. Less than or equal to 3 crore. If it is more than 3 crore, then Gaar provisions will apply. If the assessee is a foreign institutional investor and satisfy the following conditions. What conditions? Not taken benefit under DTAA and invested in securities of listed or unlisted company with the prior approval of SEBI. With the prior approval of SEBI. For them, no Gaar provisions will apply. Okay, regular class we can discuss each and every idea behind this, but this is not the time to learn the background behind why are foreign institutional investors. I have to tell you about the domestic treaty with the country of Mauritius. Okay, after that we have to understand the concept of what to say. Just now we discussed the bonus stripping. Bonus stripping, when I discuss the bonus stripping by the investments made by a FII, in that case also Gaar provisions does not apply to them. So I can tell 6-7 reasons why foreign institutional investors are away from these Gaar provisions. But as of now, that is not the discussion. So for FIIs who has not taken the benefit of double taxation avoidance and invested in the securities of a listed or unlisted company with the prior approval of SEBI, for them Gaar provisions does not apply. Or next, the aggregate of tax benefit in any relevant assessment year arising to all the parties to an arrangement is less than or equal to 3 crore, not to one party, to all the parties in an arrangement. Next, case studies. Listen from here. Every exam you take, any exam you take, Gaar provisions, case studies are coming. Last attempt, 2 bits they asked. Bit number 1, non-applicability. Bit number 2, case study. 3 marks, 3 marks, 6. Done. Oh. Okay, listen. One by one, let us focus on. See, my efforts will be completely from ICAl side. How many case studies are there? See, case study 1, like this I have written n number of case studies for you to visualize the situations. $14 case studies here. How many? 14. 14 case studies are given in study material also. 14 I covered. But each one, 1 minute I will take and I will complete. 1.5 minutes. Okay. Spare with me properly in order to have confidence. Okay. Let us begin. Case study 1. Case study 1. There is a company called as X Limited. X Limited established the industrial unit in a cess, and it wanted to claim deduction under section 10AA in respect of profits derived from export of chemicals. Actually, the point is, from a cess, if you export anything, okay, there is a tax benefit, there is a tax exemption or a tax deduction, you can call. Technically, it's a deduction. Deduction that is allowed. Under which section? 10AA. So, X Limited established industrial unit in a cess. It wanted to claim depreciation under section 10AA in respect of profits derived from export of chemicals. Okay. So next, this is a tax planning. No Gaar applicability. Reason, profit derived has a deduction under 10AA. First 5 years 100%, next 5 years 50%, next 5 years transfer to the cess RR account. Okay, cess RR account. Like this, it's so on and so forth continue. I am not here to discuss about 10AA now. That is CA inter concept, not for final. We are in final discussion now. So I don't want to touch 10AA unnecessarily now. So X Limited established a unit in sales and exported goods from that. That is tax planning here. You only gave me a chance to do that. I am availing that. If I start it in Hyderabad, I have to pay you tax. If I start it somewhere in Gujarat, in a cess which is established by the state of Gujarat, I will get exemption. That's why I started there. It's a planning. Next, they will ask you in the exam whether this is a tax planning or tax evasion or avoidance. Next, case study 2. X Limited is there. It established Unit A, established in cess. Unit A, established in cess. Again, everyone please listen, I am not telling any story. If you have any doubt, 1% doubt on me, open study material. Okay, in study material, each and every case study was given in a paragraph format, which no one can understand. That's why I am converting it into a diagram. You should understand the efforts that I am putting inside. And again I am telling you, at the AFM or DTA, unless and until if I am not confident, I will not come forward because I don't want to become a fool. So 100%, once I feel that 100% this is the best a person can give in this, then only I will step inside and I will discuss about it. So rely on what I am saying. If you have any kind of doubts, please go to the study material. Okay, done. Let us continue. There is a company called as X Limited. It has 2 units, Unit A, Unit B. Unit A, established in cess. Unit B, non-cess unit. Both engaged in manufacturing of chemicals. Okay. What happened? Unit B, a non-cess unit la manufacturing happened. Manufacturing happened. After manufacturing, final product will come na, that is diverted to unit A cess. Okay, and they shown as if it is manufactured in unit A. Okay, but actually unit A nothing is done. Cessla, no, nothing is done. No manufacturing done, no production done, no processing done. Packaging and labeling was done. Okay, and as if everything has been done in unit A, they wanted to claim a exemption under deduction under 10AA. This is a tax evasion. It is a misrepresentation of fact. Gaar does not apply. Case study 3. Unit B transferred its production to unit A. Unit B is in non-cess, unit A is in cess. Okay, unit A is in cess. So let us understand this. See, there is, as I already said, there is a unit B in non-SEZ area. There is unit A in the cess area. Okay, cess area. In the previous case, what happened? Everything is done, the manufacturing is done, the production is done, processing is done, everything is done in unit A. Just it diverts its production to unit B, unit B like was done, transferred to unit A as unit. From there they will export and tell that there is no income because 100% deduction is available for the first 5 years. They are taking a bad advantage of the provisions of 10AA. Therefore, lawmaker said that this will not be, okay, this will not be called as tax avoidance. This will be a tax evasion because there are misrepresentation of facts. So this is what we understood in this particular area. But here, what happened? Let us see. There is a unit B in non-SEZ. There is a unit A in SEZ. What happens is the goods will be transferred from, production will be transferred from unit B to unit A, from a non-cess to cess. Okay, now what they will do, they will show that we are not taking just diverting production. Unit A will pay to unit B. Unit A will pay to unit B. When unit A pay to unit B, what will happen? For this unit, it becomes a payment. For this unit, it will become a receipt. But that receipt is less than, but the receipt being the consideration that you are taking, okay, the consideration we call as a receipt. Okay, we call as a receipt. So since the consideration is less than fair market value, okay, for example, fair market value of that chemical is 10 crore. I will pay only 2 crore to them. Means income generated by unit B will be underreported. Because of that, they will pay less tax. Okay. So since the receipt is less, what will happen? Under reporting of income. Because of that, less tax. Correct? So they will show high payment here. Okay, they will show that particular payment here. But anyway, what will happen here? Unit A will take that particular thing. They will show insignificant activity. Which one? Insignificant. Means what? Already 95% of the production is completed in unit B. That is only diverted to me. Instead of showing zero amount on diversion, I will show on every 10 rupee, 2 rupees only I will pay to them. And I will tell that I paid. On face, if you see, there is a real purchase by A from unit B. But in reality, the intention was completely different. So therefore, it looks like a tax planning, but actually it's a tax avoidance. It is tax avoidance. Here, there is no misrepresentation of fact. Really production happened in B. Really payment is made by A. But how much payment? The consideration is less than fair market value. Last attempt to this question only came. If you want, check the question paper. Okay, so therefore it becomes a payment to one party, receipt to another party. Since the consideration is less than FMV, it's an under reporting of income, less tax. Next, unit A has done insignificant activity and exported, and it will claim deduction, on entire income. This is a tax avoidance. Gaar does not apply even though it is a tax avoidance. Why? SAR is available. Okay, why SAR is available? Section 10AA 9 read with 80 IA 8, clearly they said that If consideration is less than FMV and these kind of transactions happened and the diversion of production happened, section 10A or 9 says that in this case 10A deduction will not be available. Means the tax avoidance is counted within section number 10A. There is no need for general anti-avoidance rules. Next, case study number 4. Case study number 4. So let's analyze this. Again, same. Unit A is established in SS. Unit B is established in non-SS for one company. Here what happened is both are involved in exporting of chemicals. One is a newly established one is there from the very beginning. Now the trick is very simple. See what they will do. Unit B customers will come. They opened a new website. They opened a new company in SS. All the existing customers, whenever they come to give an order, they are diverted to SS unit. Means actually those all people are customers of unit B. They are diverting this to unit A and they will purchase from unit A, export will be made. Clear or not? So the orders are coming to unit A. Purchase is made from unit A. Sale is made by unit A. From this what you have to understand? In this case, prima facie if you see, unit A is doing everything. But according to real understanding of the transaction, those all people should actually go to B. B intentionally diverted them to A. Means if a person normally see what will be the opinion, unit A is selling, says unit is exporting. So take deduction under section 10A, 100% 5 years, 50% next 5 years, make government a bloody damn fool. This is how we will understand. But in reality, there is a tax avoidance. Here there is no tax evasion. Okay, there is no fraud involved. I tried to divert my particular transaction to another entity. When you look, it is like a valid transaction. But when you go deep into the analysis, it is not a valid transaction. Those which are looking like valid but not valid are called as avoiding transactions. So therefore, here this is a tax avoidance. Yes. Gaar will apply or will not apply? Gaar will not apply because already there is a section called as section number 10A clause 4. Okay. See. Unit A, profits earned are claimed as a deduction. Okay. Export orders booking through the existing and new customers. Next. This involves establishment of unit A by splitting up or reconstruction of existing business. So existing and new customers will be now diverted to unit A. There is only export to booking happened. Actually, they belong to the non-SS unit. So it is just a splitting of the existing unit or reconstruction of existing unit. This is an arrangement, not a tax evasion. Since there is no misrepresentation or false submission, so arrangement is a tax avoidance. Gaar does not apply even now because there is a specific provision for that. Next one, case law number 5. Okay, next one, case study number 5. A Limited is an Indian company. B Limited is also an Indian company. A Limited is getting amalgamated with B Limited. A Limited is called as amalgamating. B Limited is called as amalgamated. Okay. So now listen carefully. A Limited is a loss-making company. B Limited is a profit-making company. Why they are acquiring? Here comes the point. Whenever a profit-making company acquires a loss-making company, the unabsorbed non-speculative business loss, of A Limited is deemed to have been incurred by B Limited in the previous year of amalgamation. So they can take the advantage of that carry forward and set off. Then carry forward for 8 years. Okay. This is a provision given in the law itself. This is not a Gaar. This is a SAR. Why is that this is a SAR? Now what will happen? This profit-making company will reduce its tax. It will avoid. So therefore, intentionally just to reduce the tax benefit if you go for amalgamation without any genuinity in the transaction, that amalgamation will be treated null and void by the department. Amalgamation should not lack the commercial substance. Amalgamation should be for the benefit or synergy. Just to claim the losses and reduce your taxation, if you do that, already section number 72A in that subsection number 1 read with the section number 2 clause 1B definition, already this was taken care. So SAR is already there on that. If any non-genuine amalgamations happen, just to take the advantage of accumulated losses in the business and to claim the set off for next 8 years, we will not allow you. Next. A Limited amalgamated company, amalgamating company, B Limited amalgamated company, both are Indian companies going for amalgamation. Perfect. Now profit to loss happened. Now, loss-making company is acquiring a profit-making company. In this case, there is no Gaar. Such mergers happens only on the basis of High Court order. Next, case study number 7. Assessee carrying on a business or profession. Assessee carrying on a business or profession needs a machinery. Okay, needs a machinery. Okay. So they can make an outright purchase or they can make a lease. Okay. If I make an outright purchase, depreciation available. Okay. If I make a lease payment, if it is a finance lease, assessee can claim the depreciation benefit. If it is an operating lease, I can take only lease rental. Lease rental as a deduction. Am I clear? So for example, it is an operating lease. Depreciation available. I calculated depreciation. I calculated lease rental. Depreciation is less than the lease rental. I will go for leasing. So hence the SSC selected lease option. Now the tax avoidance. No, this is not Gaar attraction of an avoidance. This is a tax planning. Next. Applicability of Gaar. Now from up to here what we have seen, 7 case studies we have seen on non-applicability of Gaar. Now we are going to see another 7 case studies in the study material where Gaar will apply in those cases. What will apply? Gaar will apply. Listen, there are 3 sections. There are how many? 3 sections. 95, 97, and 98. We have to understand that. Applicability of Gaar. See, I am telling you again and again. Later you should not blame me that I did not cover properly. Okay? Take responsibility. It is your exam for 100 marks. You should qualify. You should become a chartered accountant. So it's completely your responsibility to take care. So please listen. I am not going through a story. Okay, I am telling everything in the study material. I kept efforts of around 12 hours to write the notes. Understand, absorb the content, then I am delivering it. So please show some respect on the subject and listen. Okay, it's your exam. 1 hour you will complete this one. Tax treaty shopping. Treaty shopping, that also I will cover. That is actually there in DTAA. I am covering here itself. Treaty shopping I am going to cover. Along with treaty shopping, I am also going to do the Mauritius route transaction, article number 39. That also I will cover here. Along with that, in another video of 10-15 minutes, dividend bonus stripping also I will do. Such a set off and carry forward, you need not again study that. So please try to understand. We are putting efforts only for you. So please listen to the video completely. Share it with your friends if you really find it useful. And share it with your friends if you really find that this is the first time you learned the Gaar provisions this way. Okay, that's the greatest tribute that you can pay me. Let's continue. 95. Applicability of Gaar. Applicability of Gaar. An arrangement entered into by the assessee may be declared as impermissible avoidance agreement. Which one? Impermissible avoidance agreement. An arrangement entered into by an assessee declared as impermissible avoidance agreement. Okay, then determine the consequences in relation to tax arising therefrom. Then only Gaar will apply. Means an arrangement should be an impermissible avoidance arrangement. Means if you are going into a tax avoidance agreement, that should be permissible. That should be permissible. It should not be impermissible. If there is an impermissible transaction, then Gaar will come. So see, department is empowered to apply the powers under this chapter at the stage of any step or part thereon. At the time of entering into arrangement, during any time, department can step in and stop your transaction if it is really a tax avoidance transaction. What is the meaning of impermissible avoidance arrangement? So what we read now, when Gaar will apply, an arrangement is entered into by the SSE, okay, can be declared as a IAA and determine the tax consequences. Okay, when any time during the course of transaction. Meaning of impermissible avoidance transaction. Last attempt this question also came here. Okay, please listen. Condition 1. Main purpose is to obtain tax benefit. Means that arrangement lacks commercial substance. Means there is no prudent practice. Just for tax benefit you are doing that. Okay, example. Reduction or avoidance or deferral of tax. Deferral means postponement. So reduction or avoidance of tax, or increase in the tax refund, or reduction in total income, or increase of loss. Any of these 4 is your intention. Means your intention is not to do any business. See, when you enter into any arrangement, it should grow your business. It should grow your business. For example, I teach AFM at CA final level. Okay. I am adding DT into the catalog. Into the portfolio, I am also adding DT. After thorough research on entire provisions, along with the new provisions that are going to come, now I am stepping into DT. Okay, already stepped into direct taxes for final and inter, already started long back. So final also we stepped in. Now what we have to understand from this, why you entered means what I will tell, I wanted to make DT also as one of the most valuable products from my side. To be very frank, it's a business. It's a business model. Chartered accountants are doing social service. In the business, what we do, you should be very much perfect and you should be delivering the service properly. That's the point. So it's a business model. So into the business model, previously AFM is there. Now direct tax is also added to that business model. Okay, why you made DT means I have a passion towards DT. I wanted to make money also out of direct taxes. Very simple answer. Clear? I will deliver the best content. I can make money also out of it. Then why to stop when I have an opportunity to make money? So point number one. Like this answer should be, why you taken DT means for tax planning. Direct taxes coaching I am giving for tax planning. If your venture of business is just to take tax benefit, then it will not be allowed. That's called as transaction lack commercial substance. Here that what happened. In every Gaar transaction, it lacks commercial substance. Just your intention is tax benefit. Reduction in tax liability, increase in tax refund, decrease in total income, increase in losses. This is your intention. Next. Condition 2. Which one? Condition 2. Creates rights, obligations which are not ordinarily created between persons dealing at arm's length price. If a person deals in arm's length price, those benefits and obligations don't come. Okay, and in order to attract Gaar provisions, person should misuse or abuse the provisions of this act or a tax treaty. Just to be discussed that I have given 10A deduction to you. What you are doing? You are doing everything in non-cess, diverting it to cess. But the problem is there Gaar does not apply because already SAR is there. Now we will see where Gaar will apply. Okay, next. Lacks or deemed to lack any commercial substance. Just now I told you. Transaction is carried out not for a bona fide purpose. Means intention is very bad inside. That's the meaning. So don't neglect here. Please read this particular point. Okay. Document is already available in my Telegram group. You just go to files and type GAAR. This document will be available for you. Download the document and have the full benefit of this particular document. Let us go into next one. Case study 8. Okay, let us start. See, A Limited is a resident company. P Incorporated is a non-resident company, a US company, no permanent establishment. When no permanent establishment are not treated as a resident, it will become automatically a non-resident. Okay, next. They agree to execute a project. A Limited, resident. P Incorporated, non-resident, a US company, no permanent establishment. Okay, they wanted to execute a project. That person will be giving me resources and support from USA. So consideration agreed between them is 10 crore. Who is earning 10 crore? P Incorporated will earn $10 crore. Actually on the $10 crore, converted you have to pay tax at the rate of 40%. Correct or not for the services provided? Therefore, what they have done, now see the main what has happened. This 10 crore was broken into 3 parts. Okay, they have said like this. For a design and technical service, we will pay 1 crore. Okay, for device and design and technical service. And for providing equipment and plant offshore. Okay, for providing the equipment and plant offshore. For the project there itself, they will provide the plant and equipment, everything. Asset is outside India, income also they will earn outside India. 7 crore dollars we will pay in that way. And offshore, onshore, and within India, they will provide some services. After the machine is completely ready, they will bring to India. Onshore also they will provide some goods and installation. For that they charge 2 crore. 1 crore, 7 crore, 8 plus 2, 10. That's a breakup of this 10 crore. They have shown. Why they have shown like this? Listen. Design and technical service and all this. This comes under royalty category. Section 9 will get attracted. Royalty. Whenever there is a royalty, what will happen? Okay, whenever there is a royalty, what will happen? There is tax at the rate of 10%. Actually, for a similar design, people charge 3 crore. But you have shown it only 1 crore to avoid the tax liability in India. Because 10% on 3 crore will come to 10% on 3 crore will come to 30 lakh. But 10% on 1 crore will come to 10 lakh only. So there is a $20 lakh tax avoidance. So 10% on $1 crore under section 115A clause 1B. See, this is the point. They have shown this way. Analysis I am doing. Offshore supply. They supplied outside India. Machine is located outside India. Income accrues outside India and receipt also made outside India. This is not taxable for a non-resident. $7 crore they have shown, but actually FMV is only 5 crore. At a 7 crore, they completely exempted, not taxable in India for a P incorporation. Other services are done in India, peanuts, they have shown 2 crore. On the 2 crore net basis, 40%. Actually, they should have paid $10 crore into 40% being 4 crore. Now they are paying how much? 2 crore into 40%, they are paying only 80 lakhs. Where is $4 crore? Where is 80 lakh dollar? See how many times they cheated. 5 times they cheated the department. Now, FMVs have to be considered not these values. Agreement 1 is under invoiced. Agreement 2 is over invoiced. The sole purpose is to obtain tax benefit. That's why we said this. Okay. There is a reduction in tax, or there is increase in tax refund, reduction in total income, or increase in loss. In this category, this occurs. Okay. It creates rights and obligations which are not ordinarily created between arm's length. If normally arm's length it was done, what will happen? I have an obligation to pay tax at 10% on 3 crore. Now, because it is not arm's length, I will pay tax only on that particular small amount of 1 crore. Next, there is abuse of provisions of Act. Abuse of provisions of Act. Here, abuse is not there in this example. There is no commercial substance. Okay. And it is not for intention, good intention. Now, this is the point. So, other services, this is the answer. Note, if A Limited and P Incorporated are associated enterprises, then Chapter 10A does not apply since SAR on transfer pricing chapter is applicable. Means, if these two entities are associated enterprises under the transfer pricing chapter, that chapter only will get applied because that will become SAR now. Okay. Then Gaar is not required. Next issue. Case study number 9. Okay, next one. Case study number 9. Let's see this case law. India and country Y. So, there is a tax treaty. Okay, so there is India and there is country Y. As per DTAA, there is a tax treaty. What is the tax treaty that is agreed between India and country Y? Capital gain arising on sale of shares of Indian company. If any capital gain arising on the sale of shares of Indian company, income is accruing or arising in India, taxable. Okay, that will become taxable to everyone. But because of this DTAA, what they said is, no tax will be levied on capital gain arising on sale of shares of Indian company, would be taxable only in country Y. Only in country Y, no tax in India. Okay, there is no double tax. When provided, transferor means the seller of the shares is a resident of country Y. Exception. This arrangement does not apply if the transferor holds more than 10% of the in the Indian company. So when this logic will apply, you should be resident in country Y and you should be selling the shares of a company within India, and you should not hold more than 10% of the total shares in that Indian company. Then you can take this treaty benefit. Therefore, what a person has done, the treaty is abused. That's what we discussed here. Abuse of tax treaty. Each and every point we are going to explain now. Okay. This is lack of commercial substance. This is the abuse of tax treaty. So what happened? I said, if there is a country like India and country Y where there is a tax treaty under DTAA, capital gain arising on the sale of shares of Indian company would be taxable only in country Y, no tax in India. If the transferor is a resident in country Y, and the transferor should not hold more than 10% in Indian company. Therefore, what they have done, they wanted to abuse the tax treaty. X Limited, established in country Y, obviously resident of country Y. Resident of country Y. Okay. X Limited is holding 20%. How much? 20%. How it is holding? It will be holding somewhere around 10%, or it will hold 30% or 29 point something. It will hold some amount. Okay. Through its wholly owned subsidiaries, K Limited and S Limited. Which company? K Limited and S Limited, wholly owned subsidiaries. Okay. With K Limited, it is holding 9.99% through its wholly owned subsidiary. Means it will not directly invest, it will invest through K Limited, wholly owned subsidiary 9.99. Through another subsidiary, S Limited, wholly owned subsidiary, another 9.99. So technically almost taking a 20% investment benefit or not. So here it is less than 10, here it is less than 10. They invested in P Limited, an Indian company. The sole intent of splitting the investment is to obtain tax benefit, no commercial substance. It is a impermissible avoidance agreement. Gaar will get attracted, treaty benefit is denied and taxed accordingly. Next issue. Next issue. Okay. Let us see the next one. Case study 10. Case study 10. From here, everything is expected for this examination. So please listen carefully. See. Now DTAS starts. There is a company called as a P Limited. Listen carefully. I can't repeat so many number of times at this moment. There is a company called as a P Limited, which is an Indian company. This Indian company has a wholly owned subsidiary called as S Limited in a low tax jurisdiction, tax haven. Okay. Again, Indian company is having a wholly owned subsidiary S Limited in a low tax jurisdiction. That S Limited is having huge accumulated profits. But this S Limited, if it pays a dividend out of this accumulated profits to P Limited, it becomes a taxable under section 115 BBD as a foreign dividend at higher rate. Okay. So they don't wanted to get it taxed. They wanted to do something using the abusing the treaty benefit. Okay. Such that they will bring these accumulated profits from low tax jurisdiction to India without due payment of taxes. That is their intention. Okay. Now you can also ask like this, sir, this accumulated profit, it can give directly to P Limited as a loan. If it gives loan, it will become a closely held entity for P Limited and it becomes a deemed dividend under section 222E. Whatever I am explaining here, again I explained here also. So you need not read this if you understand the diagram. Okay. So now what happened? There is an Indian company. That Indian company is having a wholly owned subsidiary called as S Limited in a low tax jurisdiction. Okay. And moreover, it has huge accumulated profits. If these huge accumulated profits are brought to P Limited, it will become dividend, or if it is given loan, it is a deemed dividend. Therefore, they wanted to abuse the treaty benefit. Why treaty benefit? Treaty benefit should be used for doing a business, not to avoid the taxes. See here what happened. S Limited has, let us say for example, $1 crore accumulated profits. If this $1 crore accumulated profits are paid as a dividend, it becomes taxable under 115 BBD. Given as a loan, it becomes taxable as a deemed dividend under 222E. So it don't wanted to do any of this. Therefore, see what happened. See how smart people are. S Limited placed this accumulated profits, this $1 crore, as deposit with K Limited, a banking company in the same country, low tax jurisdiction. Okay. See, S Limited is located in Mauritius, no tax jurisdiction. Okay. This S Limited will place a deposit. Whatever the accumulated profits are there, that all amount they have placed a term deposit. They have placed a term deposit, FD. FD is made with K Limited. What is this K Limited? Banking company located in the same country again. Okay. Now, listen what has happened. The fun starts now. FD is made by S Limited with K Limited. Putting this term deposit as a security. Putting this term deposit as a security means subsidiary is giving security for the loan taken by holding company. Now what happened? $1 crore accumulated profit. This $1 crore accumulated profit is kept as a deposit. On this $1 crore security, $1 crore loan is given to Indian company. Loan is given to Indian company. By whom? K Limited. If the same $1 crore loan is given by S2P, it becomes a deemed dividend. But now it is given through B Limited, K Limited called as a banking company. Therefore, this will not become a deemed dividend. It becomes a loan. It becomes a loan. Okay. Means accumulated profits through a round tripping transaction came into the hands of P Limited. That's the deal that was made by these two parties. See, B Limited is called as an accommodating party. Which one? Accommodating party. Concept is called as a round tripping. This concept is round tripping. K Limited is called as an accommodating party. Not B Limited, K Limited, banking company. So K Limited will be called as accommodating party, helping party. Okay, this is what happened. Now you may ask a question, sir, no sir, P Limited will pay interest, will pay interest on the loan to K Limited. If it pay interest on K Limited, then what will happen? It becomes income accruing in India for K Limited. K Limited has to pay tax. No. That is main important point. Nyayama Pata, you have to really pay. But what happened here? As per DTAA between India and that low tax jurisdiction country, interest payment to low tax jurisdiction banking company is not taxable in India. So, win-win for everyone. Who is becoming the biggest bakra in this transaction? Income tax department, the government of India. Therefore, what they have done, arrangement lacks commercial substance, abuse of treaty arrangement, it is an impermissible avoidance agreement, chapter 10A will get attracted, loan will be deemed to be the dividend, interest paid by P Limited will not be deductible expenditure. This concept of taking the accumulated profits not directly as a loan through an accommodating party, if they do this transaction, we call it as a round tripping transaction. Next, case study number 11. Let us take case study number 11. There is a company called as K Limited, Indian company, and another Indian company, S Limited. Actually, K Limited wanted to give loan to S Limited. If it give loan to X Limited, what will happen? S Limited will pay interest that becomes taxable to K Limited. Then what they have done, same round tripping again. K Limited is having a subsidiary company in a non-tax jurisdiction called as P Limited. Okay, this P Limited give loan to S Limited, and interest is paid by this to this. Since it is a non-tax jurisdiction, this interest will not become taxable to non-tax jurisdiction company. Are you understanding or not? Okay, next. And moreover, interest is deductible in his hands. So the only intention of asking P Limited to give loan to S Limited is, if you give the loan, interest becomes taxable in K Limited hands if S Limited pay. So Indian government has DTA with specified non-tax jurisdiction that income arising in India is exempt in India. Moreover, already it is a non-tax jurisdiction, no income is taxable for P Limited. If the loan is made by directly to K Limited to S Limited, it results in interest chargeable to tax, okay, in the hands of K Limited. So they are using P Limited, a company in non-tax jurisdiction, as a channel. Means it's a conduit. Means instead of directly giving, it is using them as a conduit, the channel, to give loan. Thus S Limited claim deduction on interest payment. P Limited is not subjected to tax anyway. So again, same concept here. You can pause the video and read the answer. Document is anyway there. Okay, next one. So let's continue now. So this is tax avoidance through Mauritius route. What is this? Basic proposition, let us see. What is the Article 19 saying in DTAA with India with Mauritius? Okay. If a person residing in Mauritius, a resident of Mauritius, is making capital gain income from India, means he sold some capital asset and made capital gain in India. The treaty between India and Mauritius is such that the resultant capital gain is not taxable for non-resident in India, though income is accruing or arising in India. In simple sense, what you have to understand, there is a resident of Mauritius, there is a resident in the Mauritius, that person invested in some capital asset in India, sold it, made capital gain, not taxable in India. Now the fun part started. Mauritius country has no capital gain concept itself. India only has a capital gain. That country don't have capital gain concept. Now what will happen? Because of tax treaty, they don't pay tax in India. Because there is no concept of capital gain in Mauritius, they don't pay capital gain tax also in Mauritius. They are getting double benefit. Correct? This is a naturally created double benefit. But certain people are using it in a wrong way. How? There is a company in USA. Means it is not a resident in Mauritius. It's a non-resident. It will start a shell company in Mauritius, subsidiary. This will invest in India in a capital asset as a resident company, because anyway company established in Mauritius and control is in Mauritius, means it will automatically become Mauritius company. This company will invest in a capital asset in India and sell them and make a capital gain. Through that they will divert to USA. Here tax treaty is misused again. Okay, next case study. Case study number 13. So that's it here. These are some important things I wanted to consider. Remaining are just optional one. But Gaar applies only, Gaar applies only for any investment, okay, made after 1/4/17. If anything in the question given before 1/4/17, Gaar provisions does not apply. No protection. Okay. Next. This is general answers here. From here, take the text notes I have already pinned in Telegram group. So take that and read properly. These are all ICA study material past exam questions. Difference between tax planning and tax evasion, different categories, whether they are tax planning, tax management, etc. And what do you mean by lacking commercial substance? Okay, what do you mean by consequences of impermissible avoidance? If it is impermissible avoidance agreement, what I will do? I will not give you tax benefit, I will not give you treaty benefit. Okay, we will be illustrated list examples. Illustrated list means examples. This case laws also, please read whatever we discussed till now, that only. When a transaction is arranged in one form known to law, it will attract tax liability. Where it is entered in another form, equally legal, okay, but intent of the parties to transaction may not be so. Like having a 10AA, okay, generally if you see na 10AA deduction will be given if there is an export from a SEZ unit, but intention is important, substance over the form. If you see the form na export unit exporting, SEZ unit exporting, take deduction, but intention you should see. Okay, real transaction happened in a non-SEZ unit, like that. Okay, so therefore when a transaction is genuine, then legal form is to be considered, not the substance. Okay, substance over the form. Okay, but not even substance, the legal form has to be there. If it is a genuine transaction, form is important, not the substance. But if it is a non-genuine transaction, substance over the form. Exam point. Another, giving importance to substance rather than the form. CIT versus BM Carver, there is a case law. It was held that it is open to the tax authorities to lift the corporate wheel and look behind who is there. Next one, exam point again. The arrangement shall be deemed to lack commercial substance if the substance is inconsistent with the form. Just normal points, exam points, read and leave. Okay. With this, we completed entire Gaar provisions. Please comment below as to how you felt about a super quick revision of a 6 marks area called as Gaar, treaty benefit, round tripping, accommodating parties, etc. Okay. Hopefully you like this particular video. More videos on income tax will be coming very soon as a sensation. Okay. Thank you very much.